Equity and company value. Question 10. Which of the following is a primary goal of raising equity capital for a company? A. To fulfill a contractual obligation to make periodic dividend payments to new shareholders. B. To finance the purchase of long-lived assets and revenue-generating activities. C. To ensure that the company's market value of equity equals its book value of equity. Correct answer, B. Equity capital is different from debt because it's a long-term investment that doesn't have a set end date and doesn't require you to pay it back. This capital is usually used to support the company's ongoing, profitable activities that are essential for growth and increasing shareholder value. Here are some examples. Buying other companies. Big investments in expanding the company. Buying long-lasting things like buildings, machines, and tools. Giving money to research and development projects. By using equity, the company can spread the risk of these big investments with new owners, shareholders, which is really helpful for businesses that are growing quickly, are just starting out and have a bit of a shaky cash flow. A. Incorrect. Dividend payments for common shareholders are discretionary and not a contractual obligation. Raising capital solely to pay existing shareholders is not a sustainable long-term corporate finance goal. C. Incorrect. Book value of equity is based on historical costs, while market value reflects investor expectations. Management aims to maximize market value, which often exceeds book value for growth-oriented companies. Question 9. A profitable technology company issues new shares to fund the development and launch of a new product line. This use of equity capital is best described as A. Unnecessary action to meet imminent debt covenant requirements. B. A strategic investment to finance future revenue-generating activities. C. A move to ensure the company's immediate survival as a going concern. Correct answer, B. Companies raise equity primarily to fuel growth through strategic investments. This capital is carefully allocated to a new product line, a strategic move, aiming to broaden the company's business and create revenue down the road. Equity is a stable capital source, ideal for long-term ventures like product development, where returns might be unpredictable or take time to show. A. Incorrect. Company expansion, not financial distress, is the focus. C. Incorrect. A profitable company is raising capital for growth, not survival. Question 8. Which of the following events will most likely result in an increase in a company's book value of equity, all else equal? A. The company repurchases 1 million shares at a price above book value per share. B. The company records a net loss that is partially offset by issuing new common shares. C. The company earns net income and elects not to pay dividends. Correct answer, C. When a company makes a profit, it adds that money to its retained earnings, which is a big part of its overall value. Think of it as the difference between what the company owns and owes, or just how much money is left for the owners. If the company doesn't give any of that profit away as dividends, it keeps it all, which means its equity goes up. Here's an example. Imagine a company that has $200 million in equity, makes $20 million in profit, and doesn't pay any dividends. Because of that, its book value jumps to $220 million. The book value of equity goes up when retained earnings increase, like when you keep more of your profits instead of giving them away as dividends. You bring in new equity, like by selling more shares, without having to make up for it with bigger losses or buying back shares that are worth more than what's on the books. The book value of equity goes down when retained earnings decrease because you're losing money or giving away dividends. You buy back shares that are worth more than what's on the books. A. Incorrect. Share repurchases above book value reduce equity, with the excess recorded as a reduction in retained earnings or APIC. B. Incorrect. A net loss reduces retained earnings and book value. Issuing new shares increases equity, but the net effect depends on whether the new capital raised exceeds the loss. Question 7. A company reports the following financial information at year-end. Total assets $28,500,000. Total liabilities $19,200,000. Common shares outstanding 2 million, current share price $18. Dividends declared during the year $1,200,000. The total book value of equity is closest to A, $9,300,000. B, $10,500,000. C, $36 million. Correct answer, A. To find the book value of equity, you simply subtract total liabilities from total assets. So, book value of equity equals total assets minus total liabilities. Book value of equity equals $28,500,000 minus $19,200,000 equals $9,300,000. No need to worry about the number of common shares, their current price, or any dividends declared for this calculation. The book value of equity is already right there on the balance sheet in the Assets and Liabilities section. Question 6. Which of the following statements about a company's market value is most accurate? A, it is a direct and predictable result of the company's current book value of equity. B, it is determined by investors' collective assessment of the company's future cash flow potential. C, it is primarily influenced by the accounting methods chosen for depreciation and inventory. Correct answer, A. The market value or market capitalization of a company's stock is simply the current price per share, multiplied by how many shares are available. Think of it as a snapshot of what investors believe the company will earn in the future, how profitable it will be, and how risky it is. The choice is made by management, like how they invest, what kind of company they build, which companies they buy, what new products they create, and how they cut costs are the main factors that shape those future earnings. So they really affect what investors think and how much the company is worth. Be incorrect. Book value is historical and based on accounting, while market value is forward-looking and based on investor sentiment. Changes in book value may not impact market value if investors don't believe in future cash flow conversion. C, incorrect. Stock prices reflect the collective expectations of the market about a company's future performance. Question 5. An analyst is evaluating the profitability of a manufacturing firm and gathers the following financial information as of the start and end of the fiscal year. Beginning total assets $84 million. Beginning total liabilities $50 million. Net income for the year $6.8 million. Total revenue $42 million. Ending shareholders' equity $42 million. Shares outstanding 5 million. Year-end share price $12.50. What is the firm's return on equity for the year, using the beginning book value of equity? Is 16.2%, B 20.0%, C 22.1%. Correct answer, B, SHEASHE. To find the beginning book value of equity, we subtract the beginning total liabilities from the beginning total assets. So, $84 million minus $50 million equals $34 million. Next, we calculate the return on equity by dividing the net income by the beginning book value of equity. That's $6.8 million divided by $34 million, which gives us 0.20 or 20.0%. Just so you know, the ending shareholders' equity of $42 million isn't included because the return on equity formula, when using the beginning book value, needs the equity at the start of the year. Also, total revenue, shares outstanding, and the year-end share price don't really matter for the return on equity calculation. They're just things that might distract you. To figure out return on equity, we usually divide net income by the equity's value at the start of the year. This way, we're looking at how much profit we made on the equity that was there at the beginning. It's a bit tricky because the ending shareholders' equity might throw us off, but if the question is asking for return on equity using the beginning book value of equity, we should stick with that method. Question 4. All else equal, Which of the following corporate actions would most likely result in an increase in return on equity? A. Increasing the dividend payout ratio. B. Raising additional equity capital through a secondary stock offering. C. Borrowing funds to retire a portion of the company's outstanding common stock. Correct answer, C. ROE stands for return on equity, which is calculated as net income divided by shareholders' equity. To boost ROE, a company can either increase its net income, the top number, or decrease its shareholders' equity, the bottom number. Buying back shares is a great way to lower the denominator, shareholders' equity, which can directly increase ROE if the company's net income remains the same. Taking on debt, borrowing increases financial leverage. If the return on the borrowed money, like when you sell off some of your equity, is higher than the cost of the debt, your net income will grow compared to your equity, which will also help increase ROE. This strategy reduces equity and uses debt to boost returns, making it the most effective way to increase ROE, assuming everything else stays the same. A. Incorrect. Higher payout ratios slow equity growth by reducing retained earnings, but dividends don't directly impact net income. Raising the payout ratio from 50% to 70% reduces retained earnings, but keeps ROE at 20%, assuming no change in net income. Higher payouts reduce funds available for reinvestment, potentially lowering future ROE. B. Incorrect. Issuing new shares lowers ROE by increasing shareholders' equity, unless offset by higher net income from profitable investments. Question 3. An analyst is preparing a weighted average cost of capital (WACC) estimate for a mature, dividend-paying firm. Which input requires the most judgment in modeling assumptions? A pre-tax cost of debt, based on the yield to maturity of the firm's outstanding bonds. B. Effective tax rate, derived from the firm's recent income statements. C. Cost of equity, estimated using the capital asset pricing model, CAPM. Correct answer, C. Figuring out the cost of equity is like trying to guess what the future will bring, which means you'll need to use your best judgment and make some educated guesses. One popular way to do this is with the capital asset pricing model, CAPM. It needs some numbers that aren't always easy to see and can be a bit of a discussion point. The risk-free rate is about picking the right government bond and how long it's good for. The beta coefficient tells you how much a stock's price is likely to swing compared to the market, and it's usually figured out from past performance. But that might not always be the best way to predict what's going to happen next. The equity risk premium is a topic that sparks a lot of discussion. It's essentially the extra return investors anticipate from stocks compared to risk-free investments. This figure is derived from historical data, surveys, or models that all rely on some pretty big guesses about what the future will hold. One key difference between debt and equity is that equity holders don't get any guaranteed cash flow period because of this. Their expected return is all about what they think will happen, which makes it the trickiest part of calculating WACC to figure out. A. Incorrect. Pre-tax cost of debt is estimated using observable market data, like yield to maturity or interest rates, making it less subjective than cost of equity. B. Incorrect. Effective tax rate is derived from historical accounting data, calculated from past income statements, and involves less forecasting uncertainty than estimating the cost of equity. Question 2. Which of the following best describes the relationship between a company's estimated cost of equity and the expectations of its equity investors? The cost of equity represents the maximum rate of return that equity investors will accept. B. The cost of equity serves as a proxy for the minimum rate of return that equity investors require to compensate them for the risk of investing in the company's shares. C. The cost of equity equals the average rate of return that equity investors have historically earned on their investment. Correct answer, B. It clearly explains that the cost of equity is like the minimum required rate of return, or the hurdle rate. Think of it as the least amount of money investors need to get for taking on the risk of owning the company's shares. If the company can't make money that's better than this minimum, Investors won't want to lend their money, or they might sell their shares, which can drive the price down. The cost of equity is like looking ahead and seeing what the market thinks. It's not about what the company has done before, but about what investors think the company might do in the future, and how much money it could bring in. Companies use this cost as a guide because they want to get the most money out of their investments. So the rate they need to offer is basically the lowest they can get to get investors interested. A. Incorrect. Investor expectations are not limited by a maximum return. They seek higher returns, with the cost of equity setting a minimum expectation. C. Incorrect. The cost of equity, a forward-looking requirement, differs from the average historical return, a backward-looking result. Relying on historical averages ignores current market conditions and a company's present risk profile. Question 1. A company's book value of equity will most likely decrease if the company A. Uses cash to repurchase its own common shares at a price equal to their book value per share. B. Reports positive net income for the period and retains the entire amount. C. Issues new common shares at a price above their book value per share. Correct answer: A. Buying back common shares lowers the total value of your company's equity. This happens because you're reducing your assets without adding any liabilities. If you use cash to buy back shares, your assets go down right away. Since treasury stock is a special account that's against equity, your equity also decreases by the same amount. Even if you buy back shares at the same price as their book value, your total equity on the balance sheet will still decrease by the amount of cash you spend. This reduction happens because when we buy back treasury stock, we're directly reducing equity. At the same time, our assets go down, which makes the net assets measure of equity smaller. The book value of equity is calculated as total assets minus total liabilities. When we buy back shares with company cash, we're reducing our assets, but our liabilities stay the same. So the book value of equity decreases. B. Incorrect. Positive net income increases retained earnings, raising total equity and book value. C. Incorrect. Issuing new shares above book value increases equity and book value through additional paid-in capital.